Hello, everyone. Welcome to Networking with NIFA. My name is John Turner, and I am the Manager of Community Development and Research at NIFA. We started doing our webinars around April. For those of you that know, we used to have a Capital City Breakfast Club in Lincoln and an Omaha AM networking experience in Omaha, and we've merged both of those to create this webinar. So we're very happy that you're here today, and we have a great session today on agricultural programs in Nebraska. Let's see. Well, so after the presenters are done, that's the time we'll ask you to ask your questions. Go ahead and use our question feature on the webinar, and we'll be monitoring your questions throughout. And then if you do want to ask a question verbally, you can raise your hand, and then we will unmute you so you can talk. And I think we're looking forward to this today, so thanks everyone for being on. I'm going to turn it over to Dudley Beyer, who is the Agricultural Programs Manager at NIFA. So take it away, Dudley.
Hello, everyone. I'm Dudley Beyer from NIFA. We have a wonderfully diverse panel today with a wealth of ag knowledge. We have Lisa Liska from the Farm Service Agency. She's a farm loan specialist. We have Kathy Anderson, also from the Farm Service Agency. She's a production and compliance programs chief. And we have Carla Baum, the next gen administrator for the Nebraska Department of Agriculture. And we have Bob Campbell, senior vice president of Farm Credit Services of America. And I think right now I will turn it over to Lisa and Kathy.
Okay, good morning, everyone. We'll see if our presentation will come up here.
Yep, I can see it.
Can you see it? Okay, all right, very good. There we go. Okay, well, thank you. Again, my name is Kathy Anderson. I'm a production and compliance programs chief, and I'm located in the Nebraska FSA state office along with Lisa here in Lincoln. And we just like to give you a little bit of an overview of what FSA is and what our programs are. So FSA is part of the U.S. Department of Agriculture, and we serve farmers and ranchers and landowners through the delivery of the federal farm programs. And those include economic safety net programs, disaster assistance programs, conservation programs, and our farm loan programs. Generally, most of our programs are authorized by the federal farm bill legislation, and those bills generally last about 5 years. So we're looking at, we just had a bill passed in 2018, so that takes us through 2023. And then Congress takes a look at those programs and decides whether they want to make any changes in what they're providing. This slide just gives you a little bit of an idea of what our footprint or our presence looks like in Nebraska. Nationwide, FSA has about 2,100 county offices. So we generally operate through our field staff in reaching the farmers and ranchers and landowners with our programs. Here in Nebraska, we have 71 county offices and about 400 staff. And you see that we've got our offices coded in blue and in green. And the blue offices represent locations where we have both a full-time farm program and farm loan program staff. In those locations that are shaded green, we have full-time farm program staff. But the farm loan program staff is covering the needs of services in all of those offices. So they've kind of got them divided out into smaller regions. And those county offices, or excuse me, the counties that are white on the map, we do provide services there. It's just that we don't physically have an office location in that specific county. So the focus of the Farm Service Agency is really to provide a comprehensive safety net for farmers and ranchers through two primary program portfolios. And that's, again, our farm programs and our farm loan programs. And under our farm programs, which is what I'll visit with you about, and then Lisa will talk more about the farm loan programs. But under the farm programs portfolio, we kind of break it down into 3 different sections. We have what we call safety net programs, which is looking at providing economic financial safety net, our disaster programs, and then we have primarily our conservation reserve program. With regard to the farm loan programs, we've got direct farm ownership and operating loans and guaranteed farm ownership and operating loans. We have microloans, beginning farmer loans, youth loans, farm storage loans, and then other programs available as well. So with our farm programs portfolio, we'll start with just talking about this, what we call the safety net and disaster programs. And of course, we have a lot of acronyms, but we'll talk through those and tell you what those represent. So under the safety net programs, we have the ARC and PLC program. That's the Agricultural Risk Coverage and Price Loss Coverage program. And ARC PLC is the primary program for our commodity crops. So our corn, soybeans, wheat, grain, sorghum, and other crops that we grow here in Nebraska. The Dairy Margin Coverage program is also part of our safety net. And that provides risk management coverage for the margin or the difference between the price of milk and the cost of feed for those dairy producers. Under the disaster programs, we have NAP, or the Non-Insured Crop Disaster Assistance Program. And that's kind of like a crop insurance program, but it's for crops for which there's not commercially available an insurance product. And so a lot of our specialty crops, such as fruits or vegetables, or our grazing land fall under this program. And so it's a voluntary program producers can enroll in ahead of the season. And then they're going to receive financial assistance if they have low yields or loss of inventory, or maybe preventive planning due to natural disasters. LIP is our Livestock Indemnity Program to provide financial assistance for livestock deaths that are in excess of normal mortality, or maybe livestock injury caused by an other event. ELAP is our emergency assistance for livestock, honeybees, and farm-raised fish. And that's going to go to producers financially for losses that are due to disease, adverse weather events, when those losses are not covered by some other program. So it's kind of a little bit of a catch-all. ECP is our Emergency Conservation Program, and this was really an important program for us in 2019 when we had all of the flooding in Nebraska. ECP is a cost share program that helps producers repair land and fencing that it's damaged as part of a natural disaster. We had a lot of producers take advantage of this program to help get them back on their feet after those damages from the 2019 flooding. And LFP is the Livestock Forage Disaster Program. That provides financial assistance to eligible livestock producers who have pasture land that's damaged due to a qualifying drought during the grazing season. The Conservation Reserve Program is a conservation program that it's voluntary, again, for producers to enroll land into and to take it out of production. So really this program focuses on environmentally sensitive land. And in return for taking that land out of production, producers can receive an annual rental payment for up to 10 years. So the 2018 Farm Bill did raise the CRP acreage limitation to 27 million acres nationwide. And here in Nebraska, we have CRP enrollment of a little over 1 million acres. There is also a continuous CRP enrollment that's ongoing at the FSA county offices. So if someone has an interest in putting land into CRP, there's really 2 types of sign-up periods we have. We have a continuous sign-up for certain types of practices, and then we have a general sign-up that occurs kind of just every so often as determined by USDA. But that continuous sign-up is always available for certain types of practices. Through the years at FSA, we are tasked with implementing ad hoc assistance programs as they're passed by Congress. And currently, one of those programs is the Coronavirus Food Assistance Program. We've been accepting producer applications for CFAP since, I believe, sometime in May. This provides direct financial assistance to producers whose operations have been negatively impacted by the COVID-19 challenges. And this program does apply to many Nebraska commodities, both crops and livestock, including cattle, hogs, and sheep. And we want to be sure that we get the word out to everyone about the CFAP program, because we think it's been really important for our Nebraska ag producers. To date, we've issued about $500 million under this program, and it does have a deadline of August 28th. So we appreciate any assistance that we can get with getting the word out to folks who might be eligible for this program. With that, I'm going to turn it over to Lisa Liska to talk about farm loan programs.
Kathy, and good morning, everyone. Again, I'm Lisa Liska. I'm a farm loan specialist located here in Lincoln in our state FSA office. And I'm going to go over a little information about our farm loan programs portfolio. The two biggest items in our portfolio are our direct loans and our guaranteed loans. We provide direct loans for operating and farm ownership needs. And when I say direct, I'm talking about how FSA directly works with the family-sized farmer or rancher in providing them that credit. Guaranteed loans is a little different in that we work directly with local financial institutions, including Farm Credit and NIFA, on loans that can be done in partnership with us, or we can do it as guarantees. So a little bit about those programs. Operating loans, direct operating loans, those are loans that can be either a one-year note for annual operating needs, such as, you know, your operating expenses like seed, fertilizer, feed, and those types of items. We also can provide an operating loan that has a maximum term of 7 years for purchases such as machinery and equipment and breeding livestock. And the loan limit on that is $400,000. For direct farm ownership loans, that is a loan where we can provide financing to purchase farm ground or ranch land. It can also be used to construct new or improve existing farm or ranch buildings, and there's also conservation practices that can be included with the farm ownership loans. The loan limit for direct farm ownership loans is $600,000, and we can go up to a maximum of 40 years on that term. And one thing I want to point out there is we recognize that $600,000 isn't necessarily always enough to purchase land these days. And so a lot of our ownership loans are done in conjunction with other partners. And like I mentioned, we work with local lenders and Farm Credit and partner with them in order to provide you enough financing for those purchases. And then the guaranteed loans, that's where commercial lenders extend credit to family farm operators and owners who do not qualify for standard commercial loans. So it's a program where FSA works with the lender in order to provide a farmer or rancher credit that they otherwise would not have extended. With that guarantee, we are providing the lender up to a 95%. It depends. The guarantee can be anywhere from 80 to 95%. Majority of the guarantees we do are around 90. That provides the lender some extra security and assurances in order to provide someone who's maybe in a little financial distress situation a loan that they otherwise wouldn't have. In guaranteed loans, we have a lot higher loan limit that can be up to $1,776,000. And so that's just a little bit about our direct and guaranteed loan programs. On the next slide, I will discuss a little bit about some of our other items that are maybe not as large in our portfolio, but we do. We make loans, majority of the loans that we make are to beginning farmers because we are here to provide credit access to those who can't get a loan at the bank. So a lot of times we're helping people get started or, with trying to get into farming, or perhaps they've struggled lately and we can step in to provide financing when the bank wouldn't otherwise. And so a little bit about that, like I mentioned, beginning farmer loans. We do have some loans that are specifically for beginning farmers. It provides credit opportunity to those who have been farming for 10 years or less. That is our definition. And for example, one of the specific loans for beginning farmers is to purchase land. We have a beginning farmer down payment loan program. Where we can partner with another lender to provide you financing with a very low down payment of 5%. And so that gives beginning farmers an opportunity to purchase land and gain extra in their capital. Another program we offer is a microloan. This one's kind of newer to our portfolio. These loans are a very simplified application process, and they're limited to only $50,000. So a lot of times this works really well for someone who's like a non-traditional operator, has a small niche operation, specialty crop, perhaps someone who is fruit and veggie farmer who sells to the farmers markets. It also works really well for kind of what I like to call an introductory loan. So maybe you're a younger applicant who's just got out of college and you want to just get started, and this might be the first loan to explore and do. So we do microloans for both operating needs and farm ownership needs. And like I said, that's limited to a $50,000 loan amount. And it is a simplified application process compared to our other applications for direct operating and farm ownership. And then the last loan I'll talk about options are farm storage facility loans. These loans are available for anyone who wants to add storage. So mainly grain bins. We can also do things like dryers, grain legs and such, handling equipment. It's a very low interest rate that we can provide to the producer. You can borrow up to $500,000 per loan. There is no limit on how many loans you can get. There is a down payment requirement. It's around 15% for most loans. We do have a microloan option within the farm storage facility loans that is a lesser down payment amount, but majority of them require that 15% down. And you do have to have the eligible commodities in order to be eligible for that farm storage facility loan. A couple others that aren't mentioned on this slide, we also have youth loans available and emergency loans. Youth loans are available for kids who are maybe involved in 4-H or FFA. That's a $5,000 limit. We do that to children who are between the ages of 10 and 20. So it's a great little program to help someone get started with their 4-H project, hold them accountable in learning to repay a loan. Emergency loans, those come into effect when a disaster has been designated, and those loans then can be provided for losses, both physical and production losses. And so if you have any other questions or you want to see more information about farm loans, I would recommend that you contact your local county office, or you can go to farmers.gov. There's some great resources on there that give you more information about the loan programs and how to apply. And with that, I'll turn it back to you, Kathy.
Thanks, Lisa. Just one more slide we wanted to mention. As far as our operations with all of our offices, certainly the pandemic has impacted us just as it has everyone else. But we remain open for business, and we've learned how to do business in some new ways using phone, email, and online tools. So we've been able to continue, and even doing, one of the main tasks we do every year about this time is take acreage reports from all producers. And we've been able to leverage those tools to facilitate taking those acreage reports. So just as all of you have, we've learned to do business in some new ways. Some of our county offices currently are open for in-person by appointment only business, and that's a status that varies county by county. So certainly, as Lisa said, we want you to contact your county office for more information if you're interested in finding out more about our programs, but contact them by phone first to find out what status they are in. We have been able to implement some additional program flexibilities, both under our farm loan portfolio and our farm program portfolio, to assist producers as we move through this pandemic. And some examples on our program side, we've had an extension of our commodity crop marketing loan terms. On the farm loan side, we've had a flexible schedule on the repayment of term operating loans. So we just really encourage you, if you have some interest or feel that there's some of these programs that could be of assistance, to reach out to our county office. And I want to mention, we do have a website for specific to Nebraska FSA, and that's a good location to go to find out more about programs and find out where your local county office is. And that's fsa.usda.gov/NE is that website. So please let us know how we can help, or if you have any additional questions.
Thank you very much, Kathy and Lisa. Next up, we have Carla Hall.
All right, I need to get back to my original screen here, just a second. Well, for some reason, it wasn't allowing me to start. Can you all hear me?
Yes.
Let's see
Yes.
me. Okay, great. I'm Carla Baum with Nebraska Department of Agriculture, and we administer the Next Gen program, which was created by the Beginning Farmer Tax Credit Act back in 1999. And so we've got 20 years of experience administering this program. We think it's a pretty good program, and this is just really going to be a brief snapshot of the program for you. So the legislature back in 1999 recognized that our farmers and ranchers are aging, and we needed to encourage the pursuit of farming and ranching in Nebraska. We needed to help that next generation of farmers and ranchers. Really, there are two huge hurdles, which is capital investment for beginning farmers, and then access to ag assets. And so what this program did was provide a tool for beginning farmers. And that tool is a Nebraska refundable income tax credit to an asset owner who will lease to an eligible beginning farmer. So there are some eligibility requirements for the beginning farmer, which I have listed here on this slide. And then the asset owner, really the only main eligibility requirements for the asset owner is that they own a Nebraska asset. So they can be an out-of-state owner, but they must own a Nebraska asset. And the majority of assets that are entered into this program is farm ground, right, for production agriculture. The Act also allows for livestock. Right now, the way the Act is written, the only livestock from the major commodities that really fits the program is cattle at this point, breeding cattle. Also for livestock production and facilities and buildings, and then also for equipment and machinery. Does require that the parties enter into a minimum of a 3-year lease. So what this really provides the beginning farmer is an opportunity to farm that asset for 3 years, with the hopes of really, forging a good working relationship with that asset owner, honing their skills as far as farming. In a perfect world, we'd like to see some mentorship going on between those parties. But really, the end goal is after the 3-year period that they've still fostered that good relationship, and that beginning farmer has an opportunity to farm that asset even longer after that 3-year period. And in the best case scenario, maybe that beginning farmer will be able to be the successor of that asset at some point. So there is another component that was added to the program back in 2008 that directly affects the beginning farmer, and that is a personal property tax exemption. So if the beginning farmer owns their own equipment and machinery for production ag, and they're paying taxes to the county assessor for those personal property taxes, or if they plan to purchase equipment within that 3-year period that they're approved in our program, then they can be exempt from paying those personal property taxes up to $100,000 valuation of equipment and machinery. So that's another, another benefit to the beginning farmer. There also is one of the requirements for eligibility is that they have an approved finance management course. This is a course that covers cash flow analysis, enterprise analysis, balance sheets, that sort of thing. And so if they take a class within a year of their application, they can also receive reimbursement in the form of a tax credit up to $500. So that's also a benefit to the beginning farmer. Another aspect is that this does work between related parties. So between parents and children, grandparents and grandchildren, aunts and uncles, and nieces and nephews, does require that they jump through some extra hoops, which has to do with succession planning. And I'm not going to go into that right now, but it is possible, and we do have related parties that have participated in the program. So really what the income tax, the refundable Nebraska income tax credit, is based on the type of lease between the parties. So typically what we both typically have is cash rent and share crop. We also do see some flex rents, which are really fall under the cash rent scenario. And here's an example of what that cash rent looks like. So 200 acres, let's say $250 an acre, equals $50,000 a year that beginning farmer is paying in rent, which equates to a $5,000 tax credit each year of the 3-year lease. And again, as I said, it's a refundable tax credit. So it comes off the asset owner's tax liability. So there is an actual line item on the Nebraska income tax form. If you show that you have a refund, you can get that as a refund. If you show that you owe taxes, that certainly comes off of your tax liability. Share crop situation, here's that same 200 acres, and this is an example of corn at $3.50 a bushel. The tax credit on a share crop is 15% of the projected owner's income off of that. And we have a formula to determine that based on the bushels per acre and a forecasted market price that we post every month. And as you can see, the tax credit is more lucrative on a share crop. The reason that that is written within the Tax Credit Act is because they recognize that in a share crop situation, the owner is sharing on some of that risk also, and where they're not in a cash rent. So so that's the basis on the tax credit. How we've seen that work in some scenarios, not every scenario, but in some scenarios, is that we'll see the asset owner give the beginning farmer a break on the per acre for cash rent. So for instance, instead of maybe charging $50 an acre, since they know they're going to get some a tax credit. In this case, it would be $25. They might lower the actual per acre rent to maybe $225 or $220 or whatever. We've seen that take place. We've also seen where the asset owner just uses that tax credit as a bonus for taking a risk on a beginning farmer. But it seems to work well. Here's some general stats. I believe the majority of these are through 2018. Since the beginning of the program, and we started issuing credits in 2000, we've issued $12.5 million in tax credits. We've had approximately 450, a little over that, beginning farmers participate in the program. One thing to know is that a beginning farmer, as long as they continue to meet the eligibility requirements of the program, they can put on multiple asset owners. They can have one asset owner with multiple assets over a period of time, as long as they still meet the eligibility requirements. So we have seen many beginning farmers come back and reapply with a new asset owner or with a different asset. The key is that an asset can only be in the program 1 3-year period. So that prevents a asset owner from renting to an eligible beginning farmer for 3 years, then taking on a new eligible beginning farmer. So again, the tax credit is tied to an asset, so that asset can only be in the program 1 3-year period. In 2011, we began keeping track of the number of acres that were enrolled in the program. And between 11 and 17, we had a little over 79,000 acres. And as I mentioned earlier, related parties can participate, and about 18% of our applications are between related parties. We did a survey in 2015, and we were able to reach 86 of those. This was a phone survey, and to really kind of gauge how we thought, how people thought the program was working. Of those 86 beginning farmers, 99% of them were still farming. So that was good news. I don't know now, 5 years later, it's probably time for another survey. But we thought that was really good news. We also think the next stat is tremendous. 85% of them were still farming the same ground enrolled in the program. So we believe that really that building relationships was working. I do know in a couple of instances where beginning farmers were able to purchase some of the farm ground that they were farming from the asset owner within this program. So that's a plus, but 85% of them still farming the same ground, I think spoke volumes. 91% of them said it was helpful. 100% said they would recommend NextGen to others. We had a few people who said, you know, after the 3 years, my beginning farmer or my asset owner wanted to hike the rent up, and I just couldn't pull it off. So I couldn't farm. I wasn't happy about that, or I couldn't farm that asset anymore. But I did get the 3 years of experience. I did get my foot in the door to start farming, and so yes, I would recommend it. It was a good experience for us. So that's really it in a nutshell. What I hope you'll find from all of today's presentations between Farm Credit Services, Farm Service Agency, and NIFA, and our NextGen program, that there are a lot of resources out there for beginning farmers. And, you know, I just encourage anybody who's looking at getting into farming, or those who want to help a beginning farmer, or if you know a beginning farmer, maximize your resources. Check out all these resources that we're providing you today, and see how you can best utilize them to a beginning farmer's advantage. So I appreciate this opportunity to visit with all of you. This is my contact information, and certainly look us up if we can be of help. And I'll turn it on to the next person.
Thank you, Carla.
You're welcome.
Next up is Bob Campbell from the Farm Credit Services of America.
Hello, everybody, and thanks for letting us be a part of the program today. So we're just a little different than your first two presenters. We're not a government agency or a state or federal. We're a federally regulated lender, and we're part of the Farm Credit System. But we utilize the programs, some of the programs that were talked about today, among others. So I thought I ought to give you a brief overview of who we are, and then and how we work with not only young beginning producers, but the ag sector in general. So my name is Bob Campbell, and I'm based here in Lincoln, Nebraska. Just an overview of the Farm Credit System, of which we're a member of. It's a different model than what you would see with traditional lending institutions such as banks. We're a cooperative, and so we would be on the left side, or if you start left to right, our customers are members, or they're shareholders of our cooperative. We're one of the farm credit associations. We're all over the country. Each association is its own entity with its own board of directors, its own policies. We have a common regulator, which is the Farm Credit Administration. And then we go through funding banks to get the money that we lend to production agriculture. They source their money through what's called the Funding Corp, which is in New Jersey, and they sell farm credit bonds through a group of dealers across the globe. So central banks, bond funds, whoever might be interested in buying bonds would buy the farm credit bonds, and then that circles back through the banks to the associations, and that's how we get the capital to lend money to producers across the country. So we cover basically 4 1/3 states, Wyoming, South Dakota, Nebraska, Wyoming, and the eastern third of Kansas. And we have offices, the red dots are our offices, and then we have financial officers scattered out across the whole area as well. Our customers or stockholders are farmers and ranchers. They can be rural homeowners in towns of 2,500 and less, or out in the country. We are able to do some lending to processing and marketing firms or farm-related businesses. So we're regulated on, we're very limited on who we can lend money to. As I mentioned, we're cooperative, and so our stockholders own us. They vote for our board, and our board governs our business. And we focus on serving rural America. That's all we can do. The one thing that is unique with our business model is we do pay cash patronage back to our customers, cash back dividends. So if our cooperative does well, then our stockholders share in that success. And for me, I've been with Farm Credit Services America for a long time. What I've always appreciated is we don't have an internal conflict between what's good for a stockholder or good for a customer, because they're both. Our customers are our stockholders. So if we can manage to satisfy one of those groups, we should be in pretty good shape. For an example, this last year, in January of this year, for last year's calendar year business, we sent back $260 million in cash back dividends. Nebraska producers received over 60 million, if I remember that right. And since 2004, we've put $2 billion of cash back into our customers' hands and then they use that money to either improve their operation or to invest in the local communities, do as they see fit with it. We can provide financing or crop insurance to producers. So we do operating loans, livestock loans. We can do term loans for equipment or breeding livestock. We do leases with a Farm Credit Leasing, which is a sister entity of ours. We do real estate loans, and we can finance ag real estate up to 30 years. And then we also provide crop insurance. So in this product suite, then there would be opportunity for us to work with, say, FSA, if we needed to work on guarantees, or if we have a young beginner buying real estate, we work with FSA to utilize their programs, maybe to help a young beginner buy some of their first pieces of real estate. And then we use crop insurance to help manage the risk of the operation, where they can prevent some catastrophic losses due to crop loss or a drought, something like that. As you would imagine, given the map I showed earlier, about 40% of our portfolio is in grains, which primarily is corn and soybeans and wheat. We have about 10% that are what we call landlords, which could be a retired producer that now just rents their ground out. And then you get into the various other industries. If you take the cattle industry, which is prominent in Nebraska, between the cow-calf industry and the feedlot, that's probably our second largest group, and then swine and dairy. When you see forest products, we participate with some other farm credits across the country that might be heavy in some areas. Like they might want some grain in their portfolio, so we trade them out for some forest products. But there's not a lot of forestation in Nebraska, obviously. What's important for us, though, is the outreach we do. And as we look at the young beginning producers, our focus is really to help them build their business acumen. What we see, young beginning producers typically are coming up through family operations most of the time. So they know how to produce, whether it's the grain or the livestock. But where we feel like we can help them is help them understand the business side of their operations. So getting them to understand their financials, understand how to do business plans and how to develop their goals, and really think strategically about where they want to take their operation, and then get them involved in being proactive in marketing. You know, as commodity producers, producers really aren't price makers, they're price takers. And the markets give them the opportunity at times during the year to maybe sell crop or their production over their cost of production. And so we encourage them to figure out what marketing alternatives can work with for them that helps them create viability in their operation. And then we have different underwriting standards for young beginners. We realize that their financial position isn't the same as somebody who maybe has been in business for 15 or 20 or 30 years. And so we have specialized loan programs. We focus more on cash flow and less on the balance sheet because they usually don't have a lot of equity. And we also work with them to figure out what in their operation is giving them an edge to be viable. If they don't have a lot of equity, are they trading labor for the use of equipment, or are they trading labor for maybe reduced rental terms, or are they what is giving them the edge to get started in the operation? And then we help them capitalize on that. And so we spend a lot of time around producer education, financials, business planning, and risk management. That's where we spend a lot of our energy, especially for young beginning producers. So that's a quick overview. I didn't want to spend a lot of time talking about the various programs because I want to make sure we had, with all the other speakers, let's make sure we have time for questions. But we would be a utilizer of the programs that you learned from the other speakers, and that's how we fit into the picture. So, and here's my contact information as well. So, John, you can have the time back, and we'll see what questions come out.
Thank you, Bob. Can you see that slide?
Yes.
Okay. Yeah, I'm just going to put up this, what I consider to be my favorite single slide that describes our NIFA Beginning Farmer Rancher program. What's the purpose of the program? It's to help beginning farmers and ranchers obtain low interest ag loans. And so it's for purchases. So it's not for an operating loan. It's not for refinancing of an existing loan. So what's the definition of a beginner? Doesn't have anything to do with age or experience. So a person could have been farming their whole lives or renting ground their whole lives and still use this program. What it does mean, the definition of beginner, is that they cannot have owned a substantial amount of farmland previously. And so what is substantial? That is, can't have owned more than 30% of the median size of farms in the county in which that land is located, if they have owned land before. And so median size is based on ag census data, and ag censuses are taken every 5 years. Here I would note that if the beginner has an undivided ownership interest, and undivided being the key here, in land that's owned by a family farm corporation, they would be viewed as owning some part of all those acres. So An undivided ownership interest, for example, 25% of 100 acres would mean that person owns 100 acres and not just 25 acres. And the other two-part test of being a beginner is that their net worth currently must be less than $500,000. So what can you purchase with our program? Land or permanent ag improvements to land, such as permanently affixed barns or silos, or if they have to do dirt work for wells or terracing. We can go up to loans up to $552,500 on those types of items. And this limit has been indexed to inflation and so far has never gone down. New equipment machinery, we can go up to loans up to $250,000. Used equipment, machinery, or breeding livestock, we can go up to $62,500. And the subset limits of $62,500 to $250,000 are not on top of the $552,500. It's within that maximum limit of $552,500. And these just represent the limits that NIFA can go up to. So the purchase price of an ag sale could actually be anything, but anything above these limits would have to be financed by some other funding source or a second loan by the bank. Who are the eligible lenders for this program? Anybody can be the lender, and the lender does not have to be located in Nebraska. The vast majority of time, the lender is a bank, but we can also do deals with private seller lenders doing a land contract with the beginner. The seller lender would receive tax exemption on the interest income just like a bank would, and because it would be for the sale of farmland, it would be viewed as an installment sale, and the income would not have to be recognized all up front. Now, we can't do land contracts between linearly related parties, so we can't have a father or a grandfather doing a land contract with a son or grandson. But an aunt or uncle could do a land contract with a niece or nephew and use this program. And I just want to make sure that these rules regarding related parties and land contracts are not to be confused with the fact that related parties can be selling land to one another when a bank is the lender. It just has to be a fair market value in that case. The eligible type of projects for this program. The loan proceeds must be used for an agricultural purpose, and the property must be located in Nebraska. It must be operated as a sole proprietorship, so we can't be part of a loan that's going to in the name of a partnership or corporation. Custom hire help is okay on the farm. The beginner must materially and substantially participate in the agricultural operation, and the loan proceeds must be solely going to the benefit of the borrower. So let's say a beginner is going to do a cow-calf operation. If the beginner owns all the cattle they're going to be on that land purchased through the NIFA program, that's okay. But if they were going to have contractual arrangements with their other outside parties to have their cattle on the land as well, then those other outside parties would be viewed as also material and substantial users of the land, and we wouldn't be able to be part of that type of loan arrangement. CRP, let's say a portion of the land that a beginner is desiring to purchase is in CRP, the Conservation Reserve Program. In that case, we would need the beginner to certify that they are not going to renew the CRP contract when it expires. And if they're willing to do that, then they could still use this beginning farmer rancher program. If there's a house or garage on the land, our beginning farmer rancher program can only help with items that are purely agricultural in nature. So either the beginner would need to come up with down payment monies that cover the value of the house and garage, or that chunk of land would need to be sectioned off and financed in a separate loan. This is where I would point out that the NIFA program can be used in conjunction with the Farm Service Agency 50-50 loan participation program. That's where the bank comes up with 50% of the funds that the borrower needs, and the FSA comes up with the other 50%. In that type of arrangement, we can treat the FSA funds as down payment funds that are covering the value of that house or garage, and then NIFA can still be part of the deal on the bank's end. The loan terms. All the loan terms are negotiated purely between the lender and the borrower, including the finalized interest rate. So it can be fixed, variable, prepayment penalties, no prepayment penalties, etc. So NIFA doesn't try to dictate any of the loan terms, but we do need to see that the loan does not go beyond 30 years and that the lender is making the representation to us that the interest rate they're offering the borrower is below their normal rate. The loan closing date, the timing of when the loan can close is tax exempt for the lender is tied to when NIFA holds its board meetings, which currently are occurring every other month. If the lender does need to extend funds to the beginner sooner than that, they can do that through an interim loan. In closing, I'd just like to say that it is possible to come to NIFA after the fact. If a qualified beginner were to realize that they had purchased land that would have qualified for the NIFA program, but they already purchased it, if they get to us within 60 days of that purchase transaction having happened, we could still drop this document called an intent resolution, and they could still use the program, and that would not be viewed as a refinancing. And that's pretty much how the NIFA Beginning Farmer Rancher program works.
Okay, thank you, Dudley, and thank you, everyone. We don't have a lot of questions. Looks like actually we have one. What are current, this question came in when Kathy and Lisa were talking, but what are current interest rates on your loan programs? And if everybody could turn your cameras back on so we can see you. Thank you.
My answer for the NIFA program
I can answer that question.
Oh, go ahead.
Oh, go ahead.
For the NIFA program,
Are they wanting to know the rate?
Go ahead, Lisa.
Were they wanting to know the rates for the farm loan programs or the farm storage facility loans? I can give both.
Sure, give both. Thank you. They didn't articulate.
Okay, so sure. The current interest rates right now for direct operating loans is 1.375. And our direct farm ownership loans, those vary depending on which type of program you participate in. So if your purchase fits within the $600,000 limit and we provide 100% of the financing, that interest rate is 2.375. If we do a participation loan where, like Dudley mentioned, the 50-50 program is what it's commonly called, we have an interest rate on that at 2.5% for our portion of the loan. And then I had mentioned about the beginning farmer down payment loan option where 5% is required for the down payment. That interest rate is 1.5%. And then if someone is interested in the farm storage facility loan programs, we have varying interest rates depending on the term of that facility loan, and the term is going to be based on the useful life of the item that they're constructing or improving. And so those terms range from 3 years to 12 years. And right now the interest rate is very, very, very low. It is at 0.25% for the 3-year and the 5-year terms. The 7-year term is 0.5%. The 10-year term is 0.625, and the 12-year term is 0.75. So the facility loan rate is below 1% right now.
Very good. And I did forget to mention that this is being recorded, so we will have this on our website, and it'll be on our YouTube channel, NIFA Housing. So that resource will be available for a long time. Dudley, were you going to also add to that? About
to answer that question for NIFA, as I stated, the bank actually decides what the interest rate is going to be, but it has to be below their normal rate.
Okay.
And I actually have
and for us, we don't really have program rates. We just have standard rates that go out for whatever loan. So for real estate, we can go from 1 to 30 years. So it really depends on what the producer wants to do. But the rates today are at historical lows. Most of your long-term fixed rates are in the 4s. And if you get into shorter amortizations, they're probably in the 3s. And so they're really effective. And if you tie in with an FSA type of arrangement for young beginners, they can really lock in some attractive rates today that are, like I said, they're historically low.
Okay, thanks. Dudley, you said you had some questions?
I got a couple of questions. Yeah, Carla, can the beginner in your program have multiple lease arrangements going on at the same time?
Yes, they can. As long as they meet all the eligibility requirements. So they can have multiple asset owners. They can put on an asset owner, let's say in 2019, and let's say that same asset owner 2 years later has another piece of ground that comes up that he needs a renter for. As long as that same beginning farmer has that, still meets the eligibility requirements, then yes, they can put on more assets. So yes.
Okay, thank you. And I have a question. I think it's probably for Lisa. Does Farm Service Agency have some type of requirement of experience, or they have to be farming like at least 2 years and not more than 10, something like that?
Yes, there is an experience requirement to qualify for a farm ownership loan. So they have to have farmed or ranched or have experience in that where they would have managed it for at least 3 years out of the last 10 years. So you do have to have that 3 years of experience before you can qualify to purchase land.
Thank you.
Okay, that looks like you guys did a great job answering everyone's questions. I think we pretty much covered everything. I did like Carla's statement about maximizing resources, and that's one of the things I definitely learned today as I listened to everyone talk about how important that is. And I'm, happy that NIFA partners with you guys, and very happy that you're able to do this today. I know I have a nephew who went through Curtis Livestock Management, and a friend's son also. So there is future farmers out there. So I think I'm going to share this video with those guys. So Dudley, any last comments you'd like to make?
John, this is Elizabeth. Could I just ask a question of Dudley real quick? He
Sure.
said that you can come in after you've purchased. Is there a cutoff time? Like, can it be 2 years later, 6 months later? What's that time frame?
They would have to have come to us within 60 days of a purchase
60 days.
transaction having happened. They have to turn in an application, and we have to draw up a document called an intent resolution, and the date on that document would need to be within 60 days of it having already occurred.
Okay, thank you. I just didn't catch that part.
Mm-hmm.
Okay, well, thank you, Dudley, Carla, Bob, Lisa, and Kathy for presenting today. We very much appreciate it. Again, this is going to be on our YouTube channel. Go to NIFA Housing. You can subscribe to our channel. We'll probably post this on Facebook, and if you go to our website under Community Development, Outreach, and Action, you can see our previous webinars and our upcoming webinars, and we do have a lot of great ones coming up. So thank you all, and have a great day.
Thank you.
Thank you.
Thank you.
Thank you.